Imagine you're at a sale. Everything in the store is 20% off. You know the sale ends tomorrow. Would you wait until next week to buy what you need? Of course not. Right now, the IRS is having a sale on taxes. Thanks to the 2017 Tax Cuts and Jobs Act, we are living through some of the lowest tax rates in American history. But the clock is ticking. On January 1, 2026, the sale ends. Today, we're going into the weeds of the Roth Conversion Strategy. This isn't just a financial buzzword. It is the single most powerful tool you have to ensure that when you age, you do it without the regret of giving the IRS a bigger slice of your hard-earned Social Security than necessary. The Tax Torpedo: Why Social Security is Different. Most people think taxes are linear. You earn more, you pay more. But for retirees, it's a curve. We call it the Tax Torpedo. Because of something called provisional income, every dollar you take out of a traditional IRA can make up to 85 cents of your Social Security taxable. Historically, this has caught millions of middle-class retirees off guard. In 2026, when the base tax rates rise, that torpedo gets a bigger engine. Let's look at a real-life scenario. Meet Sarah. Sarah has $500,000 in a traditional IRA. In 2025, she takes out $40,000. Under current laws, her tax bill is manageable. But in 2026, that same $40,000 withdrawal could trigger a higher bracket and a higher percentage of taxable Social Security. By converting a portion of that $500,000 to a Roth IRA now, Sarah makes those future withdrawals invisible to the Social Security tax formula. The math of the sweet spot, 2024 to 2025. Why is 2026 the deadline? Because right now, the standard deduction is at an all-time high, $29,200 for couples over 65. This creates a tax-free zone. The strategy is simple, but requires precision. You want to fill your current tax bracket. If you're in the 12% bracket, you should consider converting just enough from your traditional IRA to the Roth to stay at the top of that 12% line. In 2026, that 12% line disappears and becomes 15%. Over a 20-year retirement, that 3% difference on a $200,000 conversion is $6,000 in pure savings, not counting the growth. The winners are the ones doing the math today. They are looking at their taxable income line and saying, I have $20,000 of room left in this bracket. Let's move it to the Roth. The 5-year rule, the trap to avoid. Now, a warning. The Roth conversion is a powerful medicine, but it has a side effect, the 5-year rule. The IRS requires that converted funds sit in the Roth account for at least 5 years before you can withdraw the earnings tax-free. If you're 64 today and you convert in 2025, you can't touch that growth tax-free until you're 69. The losers are those who wait until they need the money to convert. They get hit with a tax bill they can't pay and a penalty they didn't expect. The winners are starting their 5-year clock today, even with a small seed conversion, so that by the time 2026 and the higher tax rates arrive, their clock is already ticking toward freedom. Before we continue, please consider subscribing to the Aging Without Regret channel. This channel was created just for you. Every day we publish content that helps you reflect more clearly and make smarter decisions about retirement, Social Security, Medicare, money management, and healthy aging. Through quality, consistent, and relatable content on practical retirement advice, retirement planning strategies, and real-world stories that highlight common retirement mistakes, financial risks, and aging challenges, we help you avoid retirement-related problems many people face today. If you're planning for retirement, feel behind financially, or want honest guidance on aging well, this channel is for you. Hit the subscribe button now.
The hidden Medicare penalty. There is one more gotta you must know. It's called IRMAA, the Income-Related Monthly Adjustment Amount. If you convert too much to your Roth in 1 year, your income might look so high to the government that they slap a surcharge on your Medicare Part B and Part D premiums. This is the ultimate loser scenario, saving $2,000 in taxes but paying $3,000 more in Medicare premiums. The winners know the IRMAA brackets. They convert to the line but not over it. They understand that 2026 is a marathon, not a sprint. They might spread their conversions over 2024, 2025, and early 2026 to stay below the penalty thresholds. Final takeaway: your 2026 protection plan. As we close, I want you to remember this. The 2026 tax sunset isn't a theory, it is a scheduled event. You can't control what Congress does, but you have 100% control over which bucket your money sits in. A Roth IRA is more than a tax-free account. It is financial insurance against a government that might need to raise rates in the future. My challenge for you this week is simple. Open your last tax return and look at line 15, your taxable income. If that number is significantly lower than the top of your current tax bracket, you are sitting on a tax sale that you aren't using. Don't let 2026 be the year you look back with regret. Start your conversion plan today. If you need a checklist on how to do this safely, I've put a link in the description to a free guide I created just for our community. Reflect on this. If you knew for a fact that taxes would be 10% higher in 5 years, what would you do differently today? Comment Roth below if you're planning to take action this year. It helps me know which topics to cover next. Subscribe to stay ahead of the curve. And remember, we don't just age, we age with a plan. I'll see you in the next video.